I mean, it's absolutely ludicrous. You versus some of these alternatives, ETP, EPD, Kinder Morgan Energy, AT&T, Verizon, all these companies, they pay dividends in excess of 6%. Now, I think that a dividend is a safe way to generate cash flow, especially if there's not too much growth in the economy, and it's kind of like a heartbeat, this dividend payment. Okay, every day your heart beats, just like every day these companies, they produce cash, and at the end of the quarter and at the end of the year they pay a dividend. And this cash, it can either be reinvested in more stock, or this cash that you have can just sit in your brokerage account. Now, I've taken a few accounting courses in my day, and Accounting 101 tells you that cash is king. And a lot of companies have forgotten that concept. And I also think a lot of investors have forgotten that concept, that cash is a great thing to have. And the only risk that I see with holding cash is reinvestment risk. Now, reinvestment risk, that's a good risk to have. I mean, that's a good problem. A bad problem, a bad risk would be if you got a margin call, or if you were leveraged way too much, and your portfolio just dropped in value just so quick that you couldn't even sell your positions. Somebody else had to sell them for you. For instance, a discount brokerage, or a major company, a major financial institution. But there's a concept in a book called The Intelligent Investor that Warren Buffett promotes quite a bit. His mentor, Benjamin Graham, wrote it. But I don't know what chapter it's in, but he talks about this balance of 25-75 or 75-25 between stocks and bonds. Now, if you apply that concept, that principle, to another concept, which is return on capital and return of capital, I think that having these core holdings can play a part as far as making sure you don't lose your money. Now, return on capital, what does that mean? It means that if, let's say, you have $10,000 invested in company X, Y, Z, and it goes up 5%, it means you made $500. That's return on capital. Now, return of capital is if you invest in XYZ, you're at least going to get your $10,000 back, and hopefully a return of $500. Now, this concept, I feel I keep in the back of my head as I invest, either on a day-to-day, second-by-second basis, or I'm thinking a little bit more long-term, the positions that I'm holding, as far as making sure that I will get my money back. Now, these companies that I listed, Johnson & Johnson, this is an excellent company. It's only gone down from in the peak of 2009 to $45, and it's right back up at $63, $64 right now, and you wouldn't have lost any of your money. And especially the past 3 years, they've increased their dividend, and every quarter they've been paying a dividend, and so you haven't lost any money. In fact, you've made money. Now, if you look at the Dow Jones Industrial Average, or if you look at the S&P 500, now if you were an index investor, you would have lost money. The Dow Jones, for instance, went from 1,400 points below 7,000 points. It was about 6,600 points, and today it's trading at 10,500 points. Now, from the peak of 1,400 to, let's just say, 7,000, that's a loss of 50%. Now, from 7,000 to 10,500, that's a gain of about 50%, but you're still down from the peak 3,500 points. So you still haven't broken even at all. You still lost money, even though if you've invested in one of these indexes, it's paid 1% or 2%. You're still in the red. But if you were to invest in one of these cornerstone companies that beats like a heart, if you have a couple of them, it just generates more cash. But if you were to invest in one of these companies, you would have at least had a return of capital and a return on capital. And as a trader, you have to think about, even if you only hold positions for a second, you have to think about this in the back of your head. But I'm kind of in the middle, intermediate, about 1 to 3 years. You have to keep this concept in the back of your head. So that is my 2 cents, and I hope you have enjoyed watching this video. This is Scott. Thank you.